Good morning, everyone. Thank you for attending. I'm going to start off my presentation with a little bit of an overview about the UK economy. Obviously, that's where we're based. First thing to say is that GDP is forecast to grow by 2% over the next 2 years, and by 2020, it's forecast to be slightly ahead of America. Unemployment is already at a very low rate at 5.1%, but is likely also to fall further this year. Inflation remains nearly zero, though is forecast to increase to approximately 1% by the year end as the oil price fall that we saw last year unwinds out of that particular calculation. We've got real wage inflation in the UK, which is obviously very positive for the retail sector. We've introduced a higher minimum wage known as the living wage that has risen from £6.70 per hour to £7.20 per hour and will rise to £9.20 by 2020. UK population is forecast to increase quite significantly by 2020 by a further 2 million. We have concerns over Brexit. And that has impacted slightly consumer confidence, although it is still positive. What is the possibility for us leaving the EU? According to the bookmakers, they normally don't get it wrong in a two-horse race. It's 5-2 on, so a 70% probability that we will be staying as we are. If we don't, what are the issues? Well, Norway have a solution. Basically, they pay 94% of the previous amount of money that they were paying to be able to trade within the EU. The Swiss has another structure where they pay nothing, but they have 120 different trade agreements. It took them about 5 years to get that sorted out. Well, we certainly don't believe it's likely to happen, but if it does, it will have an impact within the UK. We'd expect to see the pound fall by up to 20%. That has an impact on inflation because it will be imported into the UK. Consequently, we could see interest rates rise and potentially that could hit the consumer. So it wouldn't be particularly appetising for a period of time until we got ourselves sorted out. I certainly don't believe it will, and certainly the bookmakers don't either. On the positive side, retail sales have increased by 1.4% year on year. 5-year money rates are a very low rate of 90 basis points. They did touch 76 basis points in January this year, and that's down from 125 basis points in December, so a significant change. Stamp duty was increased in the last budget by 1%, and that could potentially have an impact of about £1.4 million on our valuation on a status quo basis. The business rates revaluation will come into play in 2017. The upside potentially is reduction of 40% of this cost. It will be phased in over a period of time, so we don't know exactly the main impact, but it will be beneficial to the UK retail market. Our strategy remains the same as before. We've done a number of things within the past 6 months. We've converted to a UK REIT for tax purposes. It's recognised internationally, which is very important. It's tax transparent. Everyone knows how it works. We'll be delivering a 90% distribution on our property rental income profits. And in this world where Panama and offshore tax structures seem to be very focused at the moment and highly topical, we think that this delivers a long-term stability for our shareholders. We are committed to going to the JSE main listing on our next equity raise, and we're working with Java to achieve that as we speak. The key highlights for the past 6 months. Well, firstly, the acquisition of Blackpool for £100 million, a 6.25% yield, was very important, and that's helped us deliver an increase in our distribution dividend of 3.6 pence, up 18%. Our recurring profit has been £5.5 million, and we've managed our costs during this period and seen a 6% fall in our cost ratio down to 14.2%. Our schemes are performing well. We've had 100% lease retention, tenants who could have left. On lease events, that's breaks, lettings, rent reviews, we've been able to secure an increase of 4.4% above the ERV. We also have currently 9 units under offer to new tenants, so I think, again, showing the demand for our properties. I'll skip through the financial highlights, but just identify 1 or 2 points. The loan-to-value ratio is nearly 58%. Our cost of debt is extremely cheap at 3.29% all in. We've fixed 87.5% of that, and we have an average term of 4.25 years, so we've got quite a long time to work through that. Our income statement shows an IFRS profit of 2.2 million and a recurring profit of 5.5 million, and that's the maths behind it. Our balance sheet shows an NAV of 78 pence. Onto the workers, and I'd like to thank the team for doing a sterling job and delivering some of these results. Our void rate, however, has increased slightly to 5.3%, mainly as a number of temporary tenants, has left over the Christmas period. However, with the 9 units that we have under offer, that will shortly fall below 4% and will head towards 3% relatively shortly thereafter. The 16 leasing events that we saw meant that we were able to let units on an average of 6.1 years, and we only gave away 6.4 months as a rent-free, which is down from about 2008 at the peak where it was 12 months. So again, showing a little bit more tension from the retailers. Footfall fell 1.2%, but did well compared to the national average of minus 3.9%. Our service charge is well below the national average and makes our shopping centres affordable. A little bit about each centre. Middlesbrough, part of our strategy was to create at each end a value centre and with some food. Pound Land have gone into one part of the end of the centre. We're pleased to have them because they're extremely good covenant. And we've agreed terms with Poundwill to take 3 vacant units at the other end of the centre. Again, created a strategy, so value at each end to be able to walk into where the fashion is in the centre. We've done some other lettings. We also have a BHS, British Home Stores, who went into company voluntary arrangement, which is your equivalent to your business rescue. They had 164 units within the UK. They closed 50 of them. They retained 30 on a rent reduction, of what we saw as well, and 84 remained the same on the same terms, and that's where we had within Burton, our shopping centre there, the BHS stayed on the same terms. The rent reduction was 50% of the rent. In Middlesbrough, it went from 100,000 to 50,000. Main fashion anchor, Topshop, are renewing their lease, and we've also entered into a long leasehold agreement for a vacant part of our property, small office, for the extension to the Holiday Inn, which we're pleased is performing extremely well since it's opened last year. Burton, a lot of activity in Burton, new lettings. We're having discussions with Next on upsizing them. We're talking to the council about acquiring their car park. We've exchanged on the small chapel at the front of the scheme. We've agreed terms to let that to Edinburgh Woolen Mills, and that will produce a yield on cost of 11.3%, so very pleasing. We've got 2 new fashion retailers going into the centre. One's Select, who are taking over a temporary letting that we had before, which is part of our strategy, so we're pleased with that. And New Look, who are performing very well in the UK at the moment, have come out with a new concept of New Look Man. I don't think they'll be dressing me somehow, but they are wanting to stay in the the centre, or they want to come into the centre and taking another unit as well, so very positive for the centre. So the strategy is very much to fill the remaining voids. We've got 5 units currently under offer. We'll have 3 units vacant, and we'll be able to drive the rents forward from that. Our new acquisition, Blackpool, is performing very well, and you can see that we've done a series of lettings there. We're in discussions with the local authority of the car park and with Wilkinson's, who are a value retailer, together with an analysis of whether we can put in a cinema or a hotel within that car park. So looking to grow our asset management capabilities, and hopefully we'll be able to deliver further profits and news on that in due course. The overall portfolio, in a year we've been able to create this portfolio. We've got some way to go before we're finished, but we've got 1 million square feet. We've got over 220 tenants. We've got a WALT, which is very long in terms of nearly 9 years. 84% of our tenants are national retailers, so a very strong lineup. And here is the lineup led by New Look, who will probably become a little bit bigger in due course. And our average market rent for our units is £16.81 per square foot, so very affordable within the UK. Lease expiries by rent, 37% is greater than 2022, and some of the other ones will provide us opportunities to be able to restructure things with tenants. Again, a little bit more detail on a WALT, which I'll let you read in your own leisure. The outlook for New Frontier, I think it's very positive. The UK economy is strong and growing. It's certainly one of the strongest in the Western world. I don't think that we will be leaving the economic union, but time will tell, and we need to wait for that time, because it could have a material impact on the UK if I'm wrong and the bookies are wrong. We see real wage growth. That will drive rents going forward, drive demand going forward. We see increased demand for our tenants. 9 units, sorry, for our centres, 9 units under offer is proving that. We see yield enhancement opportunities. And one of the things that we have noticed and seen is an awful lot of countries throughout the world have negative interest rates. When you start looking around the world, where do you want to invest? And you see an economy that's got GDP growth that's going to be in excess of 2% on the forecast. A lot of other countries, Japan, mainland Europe, are looking to the UK to be able to invest. And so some forecasters believe that we'll see some improvement in yields once we've got over Brexit. We want to grow the company, and we want to carry on doing further accretive acquisitions. We did speak to some shareholders at the beginning of the year about an acquisition of 2 shopping centres for £125 million. The board decided that it's best wait until Brexit is over before we press the button on that. We've been talking to the vendor. The vendor's very happy with that concept. So we hope we'll be able to announce something at our next set of results, how we'll be able to take that forward. The dividend is on track. The 7 to 9% on an annualised basis that we said that we would deliver, the increase is, we're very comfortable that we can deliver that. It's a company that's done an awful lot in the past 12 months. We'd like to thank the support of the team and of the board, and clearly of our major shareholder. It's an exciting time for us, and it's good to be in an economy that is stable with long-term growth prospects as well. Thank you all very much for listening to me, and I'll pass you over to Camille.
Thanks, Mike. Welcome, everybody, and thanks for the attendance. Appreciate you guys coming out. Before I get into the Ascension results, I just want to talk about the information represented at 29th February. As you guys know, we changed our financial year end to match that of Rebosis. So I reported at the last reporting period at 31 August for the 2-month period ending 31 August. It did provide a bit of difficulty in terms of providing calendar month comparatives. So for comparative purposes, we've used the last financial year end being 30th of June the half one results at 31 December 2014. So into the performance, I think the fund's done fantastic. The residual distribution growth that's entitled to the B shareholder grew at 8.4% when compared to 31 December 2014. Because we did this fragmented reporting in terms of 2 months in the 31 August and then 6 months now, the aggregated distribution growth, if I compare it to the prior year, is actually 11.6%. I reported that to be 10.3% as at 31 August. So we're seeing that good upward trend in terms of the B share. Obviously, the A share continues to grow at that 5% as is mandated. Net property income growth, 10.8%. I think good performance and complements the fact that the underlying assets have been performing fantastically. Vacancies, 5.8%. Again, a fantastic statistic. And the reason being is, although it's remained unchanged as at 31 August, the exact comparative at 31 December was 23%. Why 23%? There were a couple of head leases in place that have now all expired. The last head lease that expired was at September 2015. So what you're seeing there is an absolute true vacancy value. I think the team have done phenomenally well to bring down vacancies in the last 14 months from 23% to 5.8%. Also incorporated in that 5.8% is there's been an additional vacancy that unfortunately expired within the 6-month reporting period. The team has successfully managed to fill that space. So overall, to remain at that 5.8% unchanged mark has been fantastic. And I think, well done to our asset management team. Obviously, vacancies remain a focus of ours, particularly in our portfolio, and we're obviously striving to bring that down further. Hopefully, I can report that in the next reporting period. Assets under management, 4.1 billion. From a comparative perspective, it was 3.8 billion historically. The fundamental reason for the asset value going up is we've now instituted the same accounting policy, or the group policy rather, that Rebosis has in terms of doing fully independent valuations on a 6-monthly basis. The important fact in this is that we get fully independent valuations in terms of independent valuers coming in and valuing the portfolio. Having done so now at this interim regard, the asset value has moved up to 4.1 billion versus the 3.8 billion. In terms of cost to income ratio, that's complemented in terms of the overall performance of the portfolio, 9.3%, which is really fantastic when you compare it to other counters. I think the team have done fantastically well in terms of cost containment and driving efficiencies within the portfolio. So quickly, if I could just go through some of the financial highlights. Distribution growth, obviously A shares continue to grow at 5%. That equates to 22 cents per share for the 6-month period. The B share grew at 8.4%. That's 12.23 cents per share. As I mentioned, assets under management have gone up to 4.1 billion rand. And loan to value has come down to 37.1%. As at 31 August, that value was 40%. Just in terms of the distributable income statement, rental income 203.5 million translates to net income of 172.4, distributable earnings of 114 million, which obviously translates to the values in terms of the cents per share on the A and B share structure. So overall distribution growth in terms of since the Ascension has been listed. I'd just like to focus on the last section of the chart. As I reported, as at 31 August, for that 2-month period, we had annualized the distribution growth. That equated to a 10.3% growth at 4.56 cents per share. We're now communicating and have declared at 12.23 cents per share, which is 8.4%. As I spoke about earlier, if you combine and do an aggregated basis for a 6-month comparative perspective, it's actually 11.6% distribution growth. Of course, it's outside of the mandatory 5% growth on the Ascension on the A shares. So again, I think fantastic performance in terms of the B shares, and that's obviously underpinned by the strong financial performance of the portfolio. Balance sheet extracts. I've talked about investment property, 4.1 billion. That's contributed to your total assets moving up to now 4.3 versus 3.9 for the same comparative. Interest-bearing borrowings have gone up marginally by about 13 million from the last period. That's fundamentally due to some capex work that we've done on the portfolio. Our debt expiry profile, with us now taking management and ownership of Ascension, one of the things that we're focusing on is extending our debt expiry profile. We've embarked on a program to reprofile our debt. The policy that we're trying to adopt is extending debt between 3 to 4 years at the very least. What you see on this chart is the blue is at year end, or sorry, at period end, which is 29th of Feb. The plan is essentially what we've committed to or are in process of committing to in terms of extending our profile. As I said, debt that has expired, we extended for 4 years, and debt that expiring in 2016, we're in the process of finalizing extending that for 4 years as well. And then 2017 as well has been reprofiled between 3 and 4 years. So as you can see, the plan process that we've implemented in terms of reprofiling the debt has now accommodated the debt expiry profile to move further out than what it currently was. Interest rate hedges. We had a 500 million rand cap that expires within the next year. We did have a cap that expired within the 6-month period. Ascension's always had a lower cover in terms of around 60% historically. Again, in context of the group policy, we're driving this quite aggressively in terms of having adequate cover, particularly in context of what's happening in terms of interest rate cycles recently. So we've taken out post-period end, it has been confirmed, of 700 million rand. It's a swap. Like I said, that's to replace a cap that was in place historically, and now increases our overall hedge profile to over 76%, which is fantastic. Again, the term of the swap that's been taken out is on a 4-year basis. So moving into the operational side of the business, from the property portfolio, we disposed of one small asset in the office portfolio. So that's now moved the number of assets to 27 versus 28 historically. Obviously, overall now 28 versus 29. Vacancies, as I spoke about, 5.8% for the total portfolio. In terms of office, 6.8% and 0.3% in terms of the industrial portfolio. Average gross monthly rental for the office space, 91.27 rand. I think it's a good number to come in at, particularly in context of where we fare against in market. Our assets are fundamentally in Gauteng and Western Cape, and that's sort of very much benchmarked in terms of where the market pricing is at the moment. Escalations, 8.5% for the office portfolio, which is really good. We try and renew our leases at a minimum of 7.5%. Everything at the moment that's been renewed has been at 8%. And then for the industrial, 7.9%, aggregating at 8.2%. Weighted average lease period, 4.3 years. If you look at our last results, that's actually come up. The reason for that is there were a few leases that expired within the 6-month reporting period. We've renewed those leases with a minimum lease term of 5 years. The only exception is one lease that was done on a 3-year basis, but it does have the extension to extend out for another 3 years. But everything else has been done on a 5-year basis. Some additional reporting that we've now incorporated that wasn't done so historically, just segmenting out our office exposure in terms of GLA. I think it's quite a nice chart, to be honest with you. It shows the exposure of the portfolio in context of government. Obviously, we always are a government-focused or government-heavy biased fund. And ultimately shows that we now have 60% exposure in terms of GLA for government, with the remaining being private sector. We do have a retail offering. About 10% of the portfolio is retail. At the bottom of each of most of our buildings, we obviously have shops that trade. The 60% exposure in terms of government, what's nice about this is the detail that you see. So provincial government, 21.6%, national government, 29.4%, and local, 9%. I think what I like to highlight here is we've got a significant exposure to many different tenants within provincial and national. So we don't have single concentrated exposure risk just to one tenant. And that's nice in that we're selective as to who we want to get into our buildings and have a bit of sort of diversity as well, to not sort of have concentrated risk with one tenant particularly. Local government, obviously that is within government space, that can be a risky area. We are very selective as to which local government we partner with. In this instance, City of Tshwane, which is very low risk, particularly from a collections perspective. Some of the local governments do suffer from a bit of budget constraints, and thankfully, the local government that we've partnered with, we've never had any issues. I mean, it complements the fact that we don't have any provision on bad debt for any of our commercial, any of the government tenants. Provisions mainly for the private sector, funny enough. This chart is essentially the same as the previous one, but now just shows it on a net income basis. It changes the exposure to government to now be 56.3% instead of the 60% shown from a GLA perspective, with the balance being 43.7%. Obviously, the breakdown now just shows it in context of net income for the different tenants. What I've also put in is the top 5 commercial properties by value. Just nice for you guys to understand a little bit more about the portfolio. There's obviously 28 assets in total. I'll quickly go through them. Grand Central, valued at 588 million rand. GLA of 33,300 squares. Vacancy levels of 1.6%. Its main tenant is education. The Department of Education, they pretty much take up all the office space. There's also a big retail offering downstairs as well, and then in Western Cape. The Samsung building, we call it the Samsung building because the top of the building has a big Samsung sign. I'm sure you've all seen it in Cape Town. That's valued at 348 million. It's got 26,200 squares of GLA. Vacancy 9%. I just want to talk a little bit about this. This was the building that had a massive head lease, 11,000 square meters. This head lease expired in September. The current vacancy as it stands at the moment is 2,300 square meters. So that means that the team have filled up 8,400 square meters if you compare it to 31 December 2014, which is absolutely remarkable. I think furthermore in this building, as I spoke about in the financial highlights, we had 3,000 square meters that became vacant in the 6-month reporting period. We filled that space as well. So total space filled in this building is 11,400 square meters in the last 14 months. So the fact that it is 9%, it's 2,300 square meters, but I think it's testament that the team are working aggressively to fill up the space, and hopefully we can get the balance of it done. There are quite a few tenants that we are speaking to in that regard. Game building, this is in Gauteng. It's mainly filled by community safety. It's actually the entire thing's filled up by community safety, with the exception of 3,000 square meters. That's the vacancy that you see of 12.6%. It's 21,000 square meters in total. Community safety expressed keen interest in terms of filling up the balance of the space. We're quite confident we're going to be able to get them into the remaining space, and it'll become a single tenanted building, which will be fantastic for us. The Infinity building, valued at 250 million squares, it's got a vacancy of 3.3%. And then finally in Pretoria, 373 Pretoria Street, it's valued at 236 million, and it's fully let at the moment. So where to for Ascension? Ascension will continue to be a focused office fund. Obviously, it has the strong sovereign underpin, and we'll continue to enjoy that. I've spoken at the last results as well, the intention of getting the B shares relisted. It's important for us to do this because it's the only way we can keep the A shares listed and allow it to remain as an equity instrument on the main board and as a REIT. We made quite a bit of progress in terms of getting these B shares relisted. It is imminent. We're pretty much at the end of it. Unfortunately, it just hasn't happened as at the reporting date. There were delays that were experienced due to a number of different circumstances, the one being compounded by the fact that market conditions did depress quite significantly over the last 3 months, which obviously didn't complement us acquiring the asset. The way we're going to do it, we're going to be acquiring Jarrison Street, 66 Jarrison Street. I'm sure most of you that went to Wits University know the building. It's quite an iconic building in Braamfontein, quite close to Wits University. Obviously, a commercial offering with it does have government tenants. We've pretty much far down the road in terms of closing out that process, but I think the important thing for me to highlight is we've been very much in communication with the JSE regarding this particular acquisition. So much so that we shared the sale agreements and the mechanics instituted within the sale agreement in terms of how the transaction's been structured. The reason being is because the JSE have been very prescriptive as to what they would allow us to do, or what they require rather for us to do in terms of getting these B shares relisted. I'm pleased to note that we've met all their conditions. The big issue is obviously creating spread, which I spoke about in the last results announcement. Through this transaction, we will do a bit of an equity placement through with the seller, and then we're going to do a vendor placement as well, which will then create adequate spread, which the JSE are very comfortable. So if we meet all those conditions, JSE have given us their commitment that they will get the B shares relisted. We will then continue to focus to reduce vacancies. So as I said, 5.8%. I think the team's done a great job, but in my view, we still need to bring that down. I think that's ultimately our key focus for now, and obviously improve the quality of the underlying assets. So at 31 August, I said 8 to 10% growth. We've come in within that range. If you look at it on a 6 to 6 month comparative, we're slightly ahead of that range if you look at it on an aggregated basis for the last 8 months. And we are well on track to deliver that for the rest of this year. Thanks. I'll hand over to Cesar.
So just continuing with the group results of Rebosis. Again, just from a company structure perspective, we have direct portfolio of Rebosis with 19 properties, 14 being the offices and 4 nice dominant shopping centers that's performed well in the cycle, and 1 industrial property. We continue to own the Ascension Manco that manages Ascension, so we've got 1 integrated team that manages Rebosis and Ascension. We own 59% of Ascension. Camille has spoken to that, and 67.5% of New Frontier that Mike runs. Just from a financial overview perspective, distribution growth. So we up 8.3% in the 6 months. We gave a focus range of 8 to 10%, so we're well within that range in the current year. Financial highlights: the 8.3% to 56 cents distribution. Our assets are up 50% from 7.8 billion to 11.8 billion. That includes the investment in New Frontier compared to the first 6 months of last year when we didn't have that investment in our numbers, including revaluations, etc. Net property income up 7%. Again, we'll talk about this later. From a rental growth perspective, our retail has performed at 9%, and our commercial has performed at 9% as well. So from a like-for-like basis, we're 9% up. From a net property income basis, 7%. Occupancy, so vacancy down at 2.4%. At year end, our vacancy was 3.2%. However, in the first 6 months of last year, that vacancy had deteriorated at year end to that 3.2%, but it's come back now to come down to 2.4%. Cost to income ratio up slightly from 12.7% to 13%, largely because of the decision we took at our retail centers to beef up the teams on the admin side and just in terms of retail skills in assisting smaller tenants in light of the economic cycle that's forthcoming. So it's quite important for us to take proactive steps in beefing up our teams at center levels. Loan to value has come down quite nicely to 33.7% from 38% in a comparable period last year. Cost of debt has gone up, largely because we had some debt expiry that came up that we've renewed on a 4-year basis that came up in March this year. And we've also increased our hedge profile. We'll talk about that shortly. What we also have done is we've included a lot of appendices, which I'm not going to go through, but it's really just for your reading in our pack. And there's a lot of segmented information that's included there. Distributable income statement, again, net property income 322 million, 7% up. The rental income being 7%, and facilities management income only going up by 0.5%, which is good. We like that income not to go up. Historically, that income has been going up a lot higher. Operating costs well contained at 6.4%. Again, I'll just rather focus on the distribution growth here of 8.3. The number of shares, we had some share buybacks reduced from 580 million units to 516 million units. Balance sheet extract, again, growth in the assets. Investment property growing from 7 billion to 7.9. Investment Ascension, 998. That's pretty much the Bs, and a portion of the As that we own, 9% of the As, and 100% of the Bs that we own, which effectively gives us 59% in Ascension. The investment in New Frontier, 2.6 billion, which is the effective 67.5% holding that we have in New Frontier. Again, the right to manage, that's the Ascension Medical at 165 valuation. Our debt is 36% up in numbers, from 3 billion to 4 billion rand. And our NAV has picked up 32% up, which is quite phenomenal. Investment profile, assets under management is just a split. We've got more segmented information again at the back for information to go through. The assets, direct assets, make up 67%, which is the 8 billion assets in Rebosis. Ascension making up 1.2 billion, which is 10% of the value, and New Frontier making up 23%. Distributable income, 57% of that 67% value being income from Rebosis. Ascension making up 18% and New Frontier making up 25%. Borrowings. As I said, the borrowings are now call it 4.1 billion. The average interest rate at 8.7%. The loan to value, 33.7, so it's come down quite comfortably. The debt at fixed rate as at February end was 75.8%. Post year end, we've increased that hedge profile to 85%. Quite important in an interest rate cycle that's going up. So we've increased that hedge. We're adopting a very conservative view on debt management and hedge management in the group. Interest cover remains at 3.1%, and the portion of our DMTN program bond is 10.5% of our debt. Again, just breaking down the debt hedge profile. Starting with the debt profile of 4 billion, the weighted average interest rate at 8.7%. At period end, the profile of debt of that was 2 years. Post period end, we've extended that to 2.1 years with the debt that came up that we renewed on 4-year basis. And the plan which we are about to conclude will extend that debt profile to 2.4 years, effectively. Notwithstanding all of these impacts, because the liquids are up and reserving costs are up, we still able to absorb them within our numbers and come within our focus range. The existing debt profile, historically we had caps of 1.2 billion at a weighted average of 6.5, so we're above that cap, so we are fully hedged on that cap. So there's no gap between the cap and the floating. The swap at call it 2 billion at a rate of 7.4. That swap includes the swap we've just taken post year end of 4 years, and the debt at fixed rates of 272. So just going shortly to our property portfolio. Again, there's a lot of segmented information on that debt and hedge profile that we find at the back, but we can just go through. Property portfolio, retail at 3.5 billion, 2.594 billion, comprising of the 4 assets. I go through in detail on these 4 assets again later. 14 office blocks valued at 4.2 billion. And 1 industrial, making up the 7.9 billion rand, 19 assets. Again, if you look at the value per square meter of our retail at 22,000, and you look at peer comparison in the market, it's still a long way on the upside. There's a lot of upside in terms of that value, given especially the trading densities and the rental sales that we see. If you look at just again on the average in-force escalation, 7.4 on the retail. Office, 8.5. We're quite careful on the office not to have a very high escalation rate, because at the end of a lease, then you're likely to have adjustment to market and a drop on income, so we carefully manage that. Again, if you look at your average rent per square meter, very important, especially on the office space, where we have buildings let to government, 96 Rand average, which is quite market-related and a good rate for our tenants. net cost to income ratio remaining at 13%. Sectoral spread by value, this is on the 11.8 billion assets that we have under management. Retail is 55%, and office at 44%, and industrial at 1%. Just talking about retail properties. So kicking off with Hemingway's, our valuation at 1.8 billion for Hemingway's. We've got a detailed schedule at the back again on our appendices, per property and the yield and so on of all our properties. So the total rental area, 73,000 square meters. Vacancy, 3.8%. It's gone up because of that of the platinum group that we've had on prime locations there that we're busy, our leasing team's quite busy trying to close deals there. We've replaced one of those boxes already with a tenant that's trading. Foot count, 8.6 million people. That's annual foot count. And percentage of nationals, very high, 87% for Hemingway's. Sunny Park in Pretoria, valuation of 722 million. Total rental area of 27,650. Vacancy of 2.9%. That vacancy is largely on the first floor where there's offices. So the retail space pretty much is filled up. We've got a lot of lineup of tenants in the retail space. Can't get space in Sunny Park. Food count at 9.3 million people, so very high food count. Again, it's in an area of office node. We've got a lot of people during the day visiting the center. And up the road, there's a lot of students and that sort of thing that visit the center. Again, high percentage of nationals, 85%. Blood Street. You'd recall in Blood Street that we completed the bridge. And that mall now is fully integrated. So the East Wing, which was formerly weak from a trading perspective, is now a lot more stronger. We've introduced fashion, which integrates all the way from the West Wing through the bridge into the East Wing. So you'll see the trading performance of the center, what it's done with what we've done to it. 541 million rand value. GLA has increased to 25,338. There's no vacancy in the center. It's trading very well. Foot count at 6.5 million people, and percentage of nationals very high, 86% as well. Tansani in the Eastern Cape, second largest township in the country after Soweto. Valuation for 477 million. Total rental area 35,382 square meters. Vacancy low at 1.3. You'd recall that with the Ellerins situation, Tansani suffered a bit of vacancy there, notched up all the way towards 10%. But we've been able to replace all those tenants, and you'll see on the trading density growth that we've seen since we replaced those furniture. We made a deliberate strategy not to just fill up with the lineup of tenants we had. We deliberately wanted rates offices of the council to be at the center, given it's a township center. A lot of people have to go to town and incur taxi fares to do their rates and electricity and so on. So we filled that up together with SASSA, where pension payouts can be paid, etc., etc. That's given rise to a lot of foot count, which has been positive, notwithstanding the decline in footfall counts in malls in the country. And Tansani has been doing the other way around. And that's naturally led to higher trading densities of things. So vacancy level down, 1.3, very high foot count, 9.9 million people, call it 10 million people visiting the center per annum. Percentage of nationals, 83%. That's pretty much the 4 retail centers that we have. The commercial assets, again, I like talking about the quality of the underlying assets. If you look at our top 5 assets, they're very similar to the rest of the assets. We only have 2 assets that have vacancies in the commercial space. All our assets are 100% occupied. So again, starting with Salu Building, it's occupied by National Government Department of Justice. We segment the information later, similar to what the picture you saw with Ascension. So 635 million value, 30,000 square meter building, 28 stories up, and 0% vacancy. So it's a semi-triple net lease, 1 tenant, easy to manage, easy to run, easy to understand. get paid our rentals in advance. We have zero provision for bad debt because we just don't have bad debt with the national government and provincial governments. Tenant, as I said, is Justice. Minister of Justice also sits there, and it's really quite a lovely building in Pretoria. Liberty Building, also in Pretoria. It was purpose-built for the intelligence of the military, which sits in that building. Its valuation, 604 million rand. Rentable area of 33,885. No vacancy. The intelligence has been there for the last 30 years. That building was purpose-built for them. It's coming at the, we are still enjoying the 10-year lease on that building together with the Salu building and the next building. In fact, all these buildings are on 10-year leases with different expiry dates in the future. Zero vacancy. Again, semi-triple net building. National Defence and its national government. Victoria Mkhange, National Prosecutions Authority, sits in that building as a tenant. National government again, 598 million rand value. That lease is coming up next year. We already have the undertaking that that lease will be renewed on a long-term basis. So we're quite comfortable with that. It's very pleased. The value of that building has also gone up because as the lease comes towards the tail end, the valuation deteriorates. With that, we've seen an uptick on that value. Zero vacancy. We've got a lot of grounds. It's a kind of an office park in the east of Pretoria. A lot of grounds where they use as soccer fields and that sort of thing. But we've got room to expand those tenants into that office node. At some point, they were looking at acquiring that building from us, but they didn't have authority from National Treasury, and they're looking at committing again on a long-term basis. As you know, we've got a big facility management contract that we do on that building for the NPA. They literally walk with their laptops. We do everything else for them. 124 Main Street in Johannesburg. It's a provincial Gauteng building, one of the best-looking buildings in town. And it houses the economic development. Again, semi-triple net lease, fully occupied by one department. Rentable area, 20,000 square meters. Valuation, 504 million rand. And the last one of those top five is in Pretoria, 340 million value, 19,000 square meters. Again, it's occupied by Water Affairs, and the tenant type is Gauteng, and it's got zero vacancy, as I said, and it's coming off a 10-year lease. There's about 4 years left on that lease. Again, just looking at the profile of these buildings, this is the nature of our kind of properties. Very high quality properties, kind of semi-triple net leases. You don't have tenant churn where people are occupying 2,000 square meters, 3,000 square meters, and they're more likely to leave and consolidate somewhere else. We don't have that challenge in our portfolio. And we continue to enjoy the renewals on a long-term lease basis. Leasing activity in the last 6 months, in the reporting period. On the retail side, we had 5,100 square meters of vacancy. That's notched up to 5,400. So notwithstanding the new lettings of 1,267 square meters on the vacant space that we had leases terminated of 1,367, which is pretty much the platinum group that went into liquidation. As I said, we replaced one of those, and our teams are they've done a good job to line up very good tenants that we are replacing the platinum group with. On the office side, we had 7,998 square meters of vacancy, and we've had new lettings of about 3,730, and that's pretty much, again, I said at the outset, we've only got 2 buildings with a bit of vacancies, and that is Other Square in Braamfontein. We've filled up some of that vacancy, 1,000 square meters of the 3,000, and another one is a Revenue Building in Pietermaritzburg It had 4,600 vacancy. We filled up the 2,600. We've got the remaining 2,000, which we're in the process of also filling up with the same tenant, who is expanding into the building department of social affairs, socio-economic development. So that leaves us with a vacancy balance of 4,200, which is 1.7% of vacancy. So that gives us a total vacancy of 2.4% in the portfolio. Again, similarly, we've done an overall segmented exposure by net income. So if you look at the appendices, you'll find the GLA segmented information, and segmented information of retail specifically, segmented information of office specifically. But just talking through this, by net income, 47.9%, call it 48, is retail, and these are all our direct properties. Edcon making up 2.6% by income. This is not. This is just off the retail, so it's not off the total portfolio. ShopRite making up 1.6. So really the biggest being Foschini Group at 3.3, followed by Mr. Price Group 2.7, Edcon and Truworths at 2.6, and the rest. National government, again, we've got diversity of tenants. We're not exposed to just one tenant within the national government in our office portfolio. We've got Justice at 9.8% of the office portfolio. State Attorney, 1.1%. So it's Justice followed by Defence Force, followed by the NPA, Water Affairs, etc. The provincial government, largely buildings that we have in Gauteng, so it's all Gauteng provincial government, 11.3%, and that's made up of economic development making the bulk of it, followed by infrastructure development, etc. And then the government agencies on the office side making up 5.4%, local government, which is pretty much City of Johannesburg, on 28 Harrison Street building, and we had one in Abu Square, but it was a consulting division that's since left, so it's pretty much 28 Harrison Street, and then 3% of the industrial, made up of the industrial property. So what this does is really just to take all our assets, total assets directly, over net income. So in other words, if there's headwinds if there's some challenges with Edcon, it gives you an idea of the impact of Edcon on our net income, and that would be 1.5% effectively. So if Edcon were to go down, it'll impact our numbers by 1.5%. So again, just New Frontier making up 19.5, Ascension 22, and the national government making 17.7 of our income, and provincial making 6.6, which is pretty much the Gauteng provincial. Government agencies making 3%, and local government, which is City of Joburg, making 1%, and industrial making 1.7. On the retail side, the highest is Foschini at 1.9, followed by Mr. Price 1.6, Truworths and Edcon maintaining 1.5. Lease expiry profile on the office and the industrial. We've got for the next 12 months 10% coming up. We're busy, our teams are busy with that, and that's pretty much in 28 Harrison Street. We have the CCMA that is already in the course of signing a new lease for renewal for us. So that's going on quite well. We don't anticipate any issues there, and another department there. Then following year, the next 12 months, is pretty much, as I said, the NPA building, which we already have some undertakings, and SASA campus out in Mafikeng, who also singly occupy the building. So we're already talking to those tenants. NPA has already indicated in writing. The others already have indicated that they don't see an issue there. So we really don't have issues. The balance is really 2020 and then beyond. Retail lease expiry profile, 17% coming up in the next 12 months. So you'd recall on our previous slide that we haven't really had any lease renewals in the last reporting 6 months on the retail, and we do now have 17% of the portfolio coming up in the next 12 months, and it's pretty much nationals. So if you look at If you look at Hemingway's, there's about 10% there, and that's pretty much the bulk of it is for Shinny and Truworths. They're doing very well. Great trading densities coming out of them, and we might get a nice rental uplift there. We certainly will get a nice rental uplift. And then you look at the next one is Sunny Park. Sunny Park is pretty much the banks, First National Bank, Standard Bank, and the Pepco Group, and they're pretty much, very positive. They're trading very well, and we're already talking to them, and we were concerned that FNB might downsize because they occupy quite a big space of 1,600, but they actually want to renew that space in full, which is quite great. So we don't have issues there. Again, in Bluth Street, we have Pepco Group in the main, and one of the banks, but they've all indicated to renew their leases. They're trading very well on those spaces. Next 12 months thereafter, I've got about 9% coming up, but we'll talk about trading densities soon, but these centres are trading exceptionally well. We're not concerned about it. Geographic spread. By value, 66% is Gauteng, and the Eastern Cape, 29%. It's been a long road, and Eastern Cape used to make a bulk of that because of the two big centres that we have in the Eastern Cape, in Tanzania and Hemingway's. That's now reduced to 29%, and by income to 25%, pretty much. Now this is exciting. So annual trading densities. If you look at the best performer in terms of trading density growth, in Tanzania, gone up by 23.6%. Again, I did mention earlier that we made a conscious decision. So this is more by design, compliments to the asset management team that sat together and we said, what can we do to, we had a lot of furniture from Ellerines in terms of bears and Ellerines itself and a whole range of things. Tenants outside who with the liquidation of Ellerines opened up vacancies. But we made a call that we'll want tenants that will bring feet to the centre. And having replaced some of those with SASA, with the blood transfusion, because we've got a big hospital up the road, there's more need for some more specialist type facilities. So put blood transfusion, because these are all tenants facing the parking. It's not inside the mall itself. So it's easy to walk in and walk out. Blood transfusion and the renal care facility, clinic, and also the BCM rates and taxes office. So that's brought a lot of feet to the centre. We've had very positive foot count growth in the centre, and people are spending more money because we've got more people in the centre and the trading density has gone up. Bluth Street is the second one at 15.7. Again, we made a decision as a team to build the bridge and integrate that shopping centre and make it more exciting and introduce more fashion. And the result is our trading density is up. Centre is far more profitable and it's trading exceptionally well. So beyond that, you have Hemingway's that's grown at 10.6%, and Sunny Park continues to trade very well. And you'd have thought of those trading densities that would be more subdued in line with what you see in the market at between 5 to 7%, but actually it's trading exceptionally well and continues to grow. So that gives you an average portfolio growth and trading density of 15%. Rent to sales, again, we see a potential upside going forward on rent to sales. Hemingway's continues to have a 7% rent to sales on a comparable period. Dansani has come down further. Now again, it's on the back of trading densities that have gone up. So 8.9% down on rent to sales. So it shows room for rental growth going forward. Very good growth. If you look at township centres generally with the other peers, they say between 5 and 7%. So that's really quite a good room for us to get the upside. Bluth Street sitting at 6%, and Sunny Park sitting at 6.5%. So very good sustainable rentals going forward. That's really what that picture shows. Outlook. We live in a challenging environment, interest rate cycle, with interest rates going up. And I think we've had the latest retail sales, which have surprised the market on the up at 4.1%, which likely trigger for more interest rates coming up. So we're taking a very conservative view on the debt and the interest rate management. We've upped our hedging to about 85%. We've extended our debt expiry profile. So those are all important measures going forward. And notwithstanding all of that, they do have impacts on our numbers, but we're still quite confident of coming within our numbers in this current year. So underlying portfolio fundamentals remain very strong. I think we've gone through performance of retail centres. We've got dominant retail centres that continue to outperform effectively in the market. We have more focus on increasing our retail portfolio, and we've stated our intention that we want Rebosis to be more retail focused. I think the strategy of investing in dominant centres pays off, and as you can see with the results, it's something that has worked well for us, and to continue to look at those kind of assets in our portfolio, and the asset management opportunities that they present, like the bridge we did at Blood Street. There's a lot of other asset management initiatives that the team is looking at on the existing centres to realise more value out of them. New Frontier continues to serve us well as a rent hedge on the back of good portfolio fundamentals, as Mark alluded to you guys. Continued focus on improving the quality of the underlying portfolio, very important for us. It starts with the lease renewals and escalations, looking after our tenants very well, not waiting for lease renewal periods, upgrading the lifts and aircons and making sure that the tenants are very happy in the buildings. We've got a lot of high-rise buildings in our office portfolio. We want efficiencies. We don't want people to wait for long for the lift and the aircon not to work. So we really have buildings that really function very well. And we're still confident of our distribution growth focus of 8 to 10%. I want to congratulate the team on excellent results. I think our asset management team and leasing teams have done well to deliver these good results. And on that note, thank you for your support and your continued support, and hopefully on the back of results like this, we'll continue to see upside in the company. Thank you. I suppose we'll leave it for questions. Thank you.